Adjunct Professor Moran, Macroeconomics 111. We're going to review how banks create money, given the guidelines issued by the Federal Reserve. So we're going to do some just basic overview before we actually do a worksheet on changing the money supply. We need to know that the United States has a fractional reserve system. The value of precious metal backing currency is only a percentage of the money supply. Right? Banks are going to make loans, but from money that is deposited in their accounts. But they can't loan out all the money. Some of the money has to be kept in reserve. Well, in case a customer walks in and wants some of their cash. So money, currency, precious metal kept on deposit. Metals are no longer used for this. It's a percentage of deposits in the bank made, by example, from cash and coins or checks. Money creation is the amount of money created in excess of the reserves, which we'll talk about this. Bank panics. When banks didn't have enough in reserve, people would run to the bank trying to get their money out. So if there's $100 deposited in the bank isn't going to keep $100 in the vault. They're going to try to loan some of it out. When they loan that money out, they're actually creating more money. And if people don't think there's enough money in the bank, then there will be a bank run or a bank panic, and people will try to get there first to get the money, and people get there later, the money will run out. The Federal Reserve regulates what reserve requirements are, and they guarantee deposits. So you really don't see, it's very rare to see a bank run anymore. I believe in the 2008 recession there were some bank runs. All right. Now, we're going to have to discuss balance sheets when we discuss how banks create money. Balance sheets are how much a bank controls and where they got the money to pay for it. So assets are things controlled by a business, and everything a business owns is used to create money. You know, it's used to further the objective of the business, which is create money. On the other side, this is called the owner's equity, which is also called net worth. So assets are paid with liabilities or owner's equity. Liabilities are money the business borrows to buy assets. Owner's equity is money contributed by the owners themselves to buy assets. So everything the business owns is paid for with liabilities or owner's equity. They're going to use T accounts to summarize accounting transactions. This is called double entry bookkeeping. Assets equal liabilities plus owner's equity. There are debits and credits. Debits are always on the left. Credits are always on the right. But to an asset, a debit is an increase in an asset value, and a credit is a decrease in an asset value. Liabilities, when you're on this side of the accounting equation, it flips. A debit is a reduction in a liability, and a credit is an increase. Similarly, for the owner's equity, a debit is a reduction in owner's equity, and a credit is an increase. This is double entry bookkeeping. Every time an accounting transaction is entered, it has to be entered twice. Once as a debit, once as a credit. Have you ever added up a large column of numbers, gotten an answer, and not know if you were correct? Well, if you add it twice and get the same answer, it's highly unlikely you made a mistake. And this is the nature of double entry bookkeeping. So for example, if the company buys a truck, that would be an asset. If they borrowed the money, their debts go up and the credit would go up. If the owners contributed the money, then the if they bought it here, this would be a debit and a credit. If they borrowed the money, their liabilities would go up. And so the debits equal the credits. Reserve requirements are a percentage of checkable deposits that by law the bank must keep on deposit in cash in the vault, or they can keep it on deposit at the Federal Reserve, which you remember we discussed the Federal Reserve as being the banker's bank. The reserve ratio is the percentage of deposits required to be kept on deposit. So for example, if the reserve ratio is 20% and a deposit is $100, $20 can be kept in the bank and $80 can be loaned out to customers. That's how banks make money, by making loans. Banks often use more than the minimum required reserves. Excess reserves are the amount of deposits in a bank in excess of required reserves. So if a bank has a reserve ratio of 20% and a deposit of 100, they have to keep $20 in reserve, and $80 is excess. In this example, I'm using 110. So if a bank has 110 deposits and required reserves are 20, then the bank can loan out $90. Money creation by banks. The bank can make a loan of this $90, and then no one takes out a loan unless you're going to spend the money, because the interest you pay on the loan is higher than the amount of interest you will earn by depositing it in an account. So when that loan is made, it is in effect new money created. If you take out a loan for college, you'll sign a piece of paper. The loan officer will make an electronic deposit to your account. In other words, nothing happened except your account balance went up. The bank just created more money. And it's not the Federal Reserve doing it. It's the bank that's doing it, just by an electronic entry, because you signed a piece of paper promising to pay them back. So when the government makes it easier for loans to happen, the amount of loans increase and the money supply increases. When the government makes it more difficult for loans to be created, then fewer loans will be made, and there'll be less of an increase in the money supply. We're now going to do some accounting entries for a typical bank transaction to see how the bank can create money by making loans.